When the RSI breaks above 70, most traders call it overbought and expect a pullback. But what really happens next? In this video, we're testing whether price keeps climbing after RSI crosses 70, using hard data from both Bitcoin and the S&P 500. Traditionally, values above 70 mean a stock or crypto is overbought and ready to fall. But what if the opposite is true in some markets? We tested this setup on both Bitcoin and the S&P 500 using two RSI settings: a fast 2-day RSI and a slower 5-day RSI. What we found was that for Bitcoin, a reading of 70 leads in most cases to further gains, while the opposite is true for the S&P 500. The trading rules were simple. When RSI crosses above 70, we enter at the close. Then we hold the position for 1 to 10 trading days. Let's start with Bitcoin. With a 2-day RSI, every holding period between 1 and 10 days was profitable. The best? Holding for 8 days gave an average return of 2.14% per trade and a win rate of 56%. The 5-day RSI performed even better. Holding for just 1 day earned 0.84%. And again, the sweet spot was 8 days, with an average gain of over 3%. That tells us one thing. Bitcoin tends to build momentum after RSI crosses 70, not crash. Now let's look at the S&P 500. The same setup produced flat or negative returns, both with 2-day and 5-day RSI. That's right. When RSI hits 70, stocks are more likely to pull back than push higher. In other words, the S&P tends to mean revert, while Bitcoin tends to trend. Why this split? A few possible reasons. Bitcoin is more volatile and retail-driven. Traders chase moves. Stocks are institutionally controlled, and those traders sell strength. Crypto often trends. Stocks snap back. Here's what you need to know. In Bitcoin, an RSI reading above 70 shouldn't automatically be seen as a sell signal. In fact, it often indicates continued short-term momentum and can present a buying opportunity. On the other hand, the S&P 500 behaves quite differently. Stocks are more prone to mean reversion, so it's often better to fade the move or wait for a pullback. The key takeaway is this: no single strategy works across all markets. It's essential to adapt your approach to the specific characteristics of the asset you're trading. For more data-driven strategies like this, visit quantifiedstrategies.com. We post tested, proven, and practical trading setups every week. And if you liked this video, give it a thumbs up, subscribe, and hit the bell so you never miss a backtest.